I'm Mark Learmonth, Caledonia Mining's CEO. I'd like to run you through our updated corporate presentation. Here you see the general disclaimer. Right, we've got a strategy focused on creating genuine returns for our shareholders, and that's focused on the completion of the Central Shaft project, which is something we've been working on for 6 or 7 years now, and is now virtually complete. And as you'll see in a moment, lies behind the increase in production to 80,000 ounces and sustaining production at that level for the foreseeable future. In addition to Central Shaft, we've also got our hands on some very attractive new opportunities in Zimbabwe, about which I'll talk later, Bilboes and Mali Green. And over the past several years, we've demonstrated a clear commitment to return money to shareholders by way of a very attractive quarterly dividend. So by way of overview, we are a highly profitable, established, cash-generative gold producer. The main activity we have at the moment is the Blanket Mine, which is situated in the south of Zimbabwe on the Gwanda Greenstone Belt. In July last year, we signed an agreement. Sorry, in July 2022, we signed an agreement to purchase the Bilboes property for a consideration of 5.1 million shares, which equates to about 28.5% of Caledonia's fully diluted equity, plus a 1% royalty for one of the vendors. Bilboes is a very substantial resource. It's got 2.5 million ounces of measured and indicated at a very good grade of about 2.2 grams a ton, which is an excellent grade for what we're expecting to be a large open pit operation. And it's fair to say that property has very substantial further exploration potential. And then slightly earlier than that, in November 2021, we also acquired mining claims over a property called Mali Green, which is also in the Zimbabwe Midlands, which has already got an inferred resource of nearly 1 million ounces. But again, I'll talk about that later. We're a Jersey domicile company, which means that we're in a tax neutral jurisdiction. Our dividends don't suffer any withholding tax. And we're listed on the New York Stock Exchange, which is where the bulk of our trading activity takes place. Also on AIM in London and the newly created Victoria Falls Stock Exchange in Zimbabwe. Last year, our revenue was $121 million. This year, our production guidance is between 73,000 and 80,000 ounces. Anybody who's been following the company will see that in the second quarter of the year, we achieved just slightly over 20,000 ounces for the second quarter. So it's pretty clear that we've already achieved our target run rate, with an all-in sustaining cost of between $880 to $970 an ounce. And again, you can see year to date that we're comfortably inside that range. I mentioned the dividend. We've paid a dividend for many, many years now. For a long time, it was a stable dividend of just about approximately 7 cents per quarter, 7 US cents per quarter. Then we started to increase it as we could see ourselves getting towards the end of the Central Shaft project. And so effectively, we've doubled that quarterly dividend. Now it stands at 14 cents. But then earlier on this year, as we knew that we were beginning to move towards a sort of a second phase in our development activity, where we'd now be looking at additional projects, we took the decision to keep the dividend level at 14 cents per quarter. That's not to say that we don't have capacity to increase the dividend further, but for the time being, we just think it's prudent to keep the dividend at 14 cents a quarter, which equates to a yield of about 5%, whilst we begin to get our arms around these new projects. We take our ESG obligations very seriously. In terms of governance, as an SEC registered company, we believe we adhere to the highest standards of corporate governance. In terms of our social license to operate, it's worth noting that the local community is a 10% shareholder in the mine, which means that they are now receiving very substantial quarterly dividends. In addition to that, we have a corporate social investment policy, which is focused on delivering real tangible benefits for people in the immediate community, and we take our environmental obligations very seriously as well. More information on all of that is set out in our ESG report, which is available on our website. So let's focus a little bit more on the central shaft, which really underpins the increased production level. What we've done starting in February 2015 is we've sunk a new shaft from surface down to 1,200 meters, about 4,000 feet. You can see the video here. This is the central shaft. It was shaft sinking was commissioned in about 2020. The shaft itself was commissioned in March 2021, and now it's fully operational in terms of it's currently focused on hoisting waste material from underground development. Which is fine. It means it's doing its job, because that means it releases the other production shaft, number 4 shaft, to focus exclusively on hoisting ore. And that's the fact that the central shaft's now working is the reason behind the increase in production that you've seen over the course of the last sort of few quarters, and that locks in our ability to continue to produce 20,000 ounces a quarter. So it's a 6-meter diameter shaft, 4 compartments. It hoists men, material, everything we need. As you'll see in a moment, it improves our access to the deeper levels of the mine and allows us to continue production and exploration. So what you see here is a cross section of the mining footprint. Is about 3 kilometers from left to right. The very dark line, the very dark black line, and the green infrastructure that you can just see now, that's what was there when we acquired this mine in 2006 from Kinross. And it gives us access to 750 meters, but not below. And you can see the mine's been running since 1907, so well over 100 years. And all those dark grey areas, those are now sort of stoped out. So you can see the existing infrastructure really doesn't give us access to the remaining ore. So what we've done is we've sunk the central shaft. That's the red thing down the middle of the mining area. And we're now busy engaged in horizontal development on 3 levels in 2 directions, which shows you, quite clearly from this diagram, it gives us access to the deeper level material, both for production, and it also gives us the flexibility now to restart our deep level exploration, which we've had to suspend for the last few years because we just simply didn't have the logistical capacity underground to conduct further exploration. So that shaft is complete. The horizontal development is progressing as we speak, and this really underpins our ability to increase production to 80,000 ounces and maintain it at that level for the foreseeable future. The only significant operating issue that we face in Zimbabwe, it relates to electricity, and there's a twofold problem. The first is a general lack of electricity in the country, which results in requirements for us to reduce our usage from time to time. Then also we do experience spikes in the voltage. So both of those mean that we have a full suite of standby diesel generators, which means that we can run those gensets and run the mine and all the development activity, but it is somewhat expensive. It's not cripplingly expensive. I mean, we can certainly afford it in terms of the cash we generate, but it's a needless expense. In addition, it clearly has environmental issues as well. So we're just in the final stages now of commissioning a solar project. It's costing about $14 million. It is a 12 megawatt solar project, and the project is already, the equipment's already there and ready to go, as you can see from the pictures. And we're just now in the final stages of the commissioning and the connecting of that solar project so it can deliver power into the mine. It will generate, it will provide about 27% of Blanket's average daily power usage, and will give rise to a saving of about $3 million a year, which, if you think of that in terms of a cost per ounce, is about sort of $35 an ounce, about 5% of our on-mine costs. So we're very pleased with that. Okay, let's turn to Bilboes, which is a transaction that we announced in July, and it's a project that we've been pursuing since 2016. So Bilboes was a large-scale, low-cost, long-life gold project. We've signed a Solon purchase agreement to purchase the property for a total consideration of, as I mentioned, 5.1 million shares, which will reflect about 28.5% of our fully diluted equity. And one of the vendors also gets a 1% NSR on the project. Bilboes already has a 43101 compliant reserve, proven and probable reserve of nearly 2 million ounces, but about just less than 2.3 grams a ton, and a measured and indicated resource of over 2.5 million ounces at 2.26 grams a ton, plus an additional inferred resource of over 500,000 ounces. And as I mentioned, it does also have considerable exploration potential. The vendors have done a feasibility study which indicates the potential for an open pit or a series of open pit gold mines producing an average of about 168,000 ounces of gold per annum over a 10-year steady state. Within that 10-year period, it fluctuates. It reaches a peak of nearly 200,000 ounces, and some years it's slightly less. The feasibility study shows a post-tax NPV of $323 million, and that's at a gold price of $1,650 and a 10% discount rate, with an internal rate of return of 33%, and a relatively low all-in sustaining cost of $826 an ounce. And all of that, the good return, the good, the relatively high NPV, and the competitive all-in sustaining cost, that really is testament to the relatively high grade for an open pit operation. Now, already as well, we've entered into a tribute arrangement, which is something that's relatively common in Zimbabwe, but less common elsewhere, which means that even before completion of this transaction, Caledonia will put funding into the Bilboes company to restart an oxide project, which we will manage. And that's expected to return to profitable operations within about 6 months. And that oxide operation, effectively, it's a pre-strip of the larger sulfide business. So it's work that we would have to do in any event, but it means that we can put the oxide material, which occurs down to a depth of about 40 meters. We can put that through the existing oxide treatment plant at Bilboes, which is currently on care and maintenance. So that will help to generate some cash flow over a period of sort of 2 to 3 years, which we hadn't previously taken account of. So it's a very nice sort of extra bonus on the transaction. Should we move forward? Okay, so the vendors have done their own feasibility study, which shows a robust project with healthy returns. The table on the right shows you some extracts from the feasibility study, which is available on our website. It's got a peak funding requirement of $250 million, and you can see at various gold prices what the post-tax NPV is and the post-tax internal rate of return. That's the feasibility study done by the existing vendors. The first thing that we will do on completion will be to commission our own feasibility study, reflecting the prevailing environment for capital costs and operating costs, but also we intend to do a feasibility study on 2 bases. One basis being a sort of a phased approach, whereby we'll address this project in 2 phases. The first phase perhaps going to 60 or 70,000 ounces, and then a second phase taking it up to 170,000 ounces. And also the existing Big Bang approach, going in a single step from 0 to 170,000 ounces. And the reason for doing that sort of dual approach is we want to be in a position whereby if funding is not available on attractive terms, either debt funding and or any equity funding that we need, if it's not available on attractive terms, we're not in the position where we have to accept unattractive terms just to get the project done. So if terms aren't attractive, we will fall back on the initial phased approach with a 60 or 70,000 ounces, then followed by a bigger second phase, which we should largely be able to fund with a very modest amount of debt and internal cash generation. So that would minimize or potentially completely do away with the need for any third-party equity. Our approach to all of this is to minimize dilution with a view to maximizing the NPV per share and also the free cash flow per share. So we're absolutely not interested in diluting shareholders unnecessarily to achieve increased production. Should we move on? Here you just see some extracts from the feasibility study. You can see the estimated production from 2025 out to 2034. Then the right-hand graph is probably less actually not particularly helpful. That shows the amalgamation of production from Blanket, insofar as we can report it under Canadian regulations, plus the incremental production coming from Bilboes. And I would point out that what you see from Blanket, 80,000 ounces in 2023 and 2024, falling to 76 and 79 in 2025-26. That's because the production that we show here in 2025-2026 for Blanket only relates to production from measured and indicated resources. In our mine plan, we also have additional production coming from current inferred resources, which we're not allowed to aggregate. Again, so looking at further opportunities, as you may know, Zimbabwe has historically been a very substantial gold producer, and is, for people who understand gold in Africa, is recognized that Zimbabwe is both very underexplored and highly prospective for gold. So historically, Zimbabwe has produced over 45 million ounces of gold, and before 2000, it was Africa's third biggest gold producer, behind South Africa and Ghana. And what we've done here on the right-hand side is there's a map of Zimbabwe, and which shows in green the greenstone deposits. And then we've superimposed over that a map of Burkina Faso on the same scale, to give you some sort of indication as to the extent of the gold ore bodies or gold areas in Zimbabwe. It is really very highly prospective. So on that basis, we continue to look in Zimbabwe. And just moving on, late last year, November last year, we also acquired another asset in Zimbabwe, which is slightly sort of further stage, late sort of second really to Bilboes in terms of its timing. But we spent $4 million in cash to buy the Marley Green property, which has got an M&I inferred resource. Sorry, a 43101 inferred resource of nearly 1 million ounces at 1.88 grams a ton. We're currently busy reevaluating the existing information with a view to upgrading that resource base from inferred to M&I. And then thereafter, given the fact that this project has now been overtaken by Bilboes, thereafter we will then engage in further exploration with a view to increasing the resource base further, as there is further exploration potential there. So in terms of outlook, our target production this year from Central Shaft is 80,000 ounces. And as you'll have seen from our second quarter production, we've pretty much achieved that run rate already. We're now working to complete the transaction to acquire Bilboes. But whilst we're working on that sort of completion and addressing the conditions precedent to the sale and purchase agreement, we're already now working to restart the oxide operations at Bilboes, which should be a 2 to 3 year operation, which will be pretty much cash generative after the first sort of 5 or 6 months. We continue to have the intention of returning money to shareholders via a dividend, and at the same time investing the incremental cash flow that's coming out of Blanket at the higher production level, investing in new projects for further growth. And it's fair to say that whilst we've got our hands on Bilboes and we've got our hands on Marley Green, we also continue to evaluate further investment opportunities in Zimbabwe with the expectation of becoming a multi-asset Zimbabwe-focused gold producer. So in terms of contacts, we've got contact information for myself here and for Camilla, our VP Investor Relations. You've also got the contact information for our Nomad in London and our broker in London. And we also show on this slide that investment research is available from Senkos and Librum in the UK, from Cantor Fitzgerald in North America, and Standard Bank in South Africa also cover us. So with that, thank you very much.